Welcome to Tradewinx software. Using the dividend discount model. 1. Understand the definition. The dividend discount model, DDM, considers the dollar value of dividends paid to shareholders. This model also factors in a projected growth rate of the dividend. Dividends are discounted to their present value using a discount rate. If the dividend discount model values the stock at a higher price than the current market value, the stock's price is considered to be undervalued. The DDM formula is dividend per share, discount rate, dividend growth rate. 2. Consider the growth rate for dividends. A dividend is a payment of a company's earnings to shareholders. If a company's earnings are expected to grow, an analyst may also assume that the dividends paid to shareholders may grow. You should assume a growth rate for the DDM formula. Say, for example, that your company has earnings for the year of $1 million. You decide to pay $500,000 to shareholders in the form of a dividend. If your firm had 500,000 shares of common stock outstanding, you would pay a $1 dividend on each share of stock. Assume that the company earns $2 million in the following year. The firm may decide to pay a larger dollar amount as a dividend, say $1 million. If the number of common stock share is still 500,000, each share of stock would receive a $2 dividend. 3. Apply a discount rate. The discount rate is the percentage rate used to discount future payments into today's dollars. Discounting payments to the current day allows the analyst to make a apples-to-apples comparison of cash flows from different periods of time. Remember that, for this formula, the discount rate is the rate of return required by the investor. It should take into account the stability of the dividend payment. For example, if the dividend payment is erratic, the discount rate should be higher. Assume that you expect to receive a $100 payment in 5 years. Assume also that the discount rate each year will be 3%. You can use a present value table to determine the present value factor for $100 received in 5 years, at a discount rate of 3%. The factor is 0.86261. Other tables or calculators may be slightly different, due to rounding. The present value of the payment is $100 multiplied by 0.86261 equals $86.26. 4. Input your assumptions into the DDM formula. The DDM formula is dividend per share, discount rate, dividend growth rate. Dividend per share is the dollar amount of dividend paid for each share of common stock. Assume the dividend is $4 per share. The discount rate is the investor's required rate of return. Assume a 12% discount rate. Assume a 4% percentage rate of dividend growth each year. The DDM formula is $4, 12% to 4%, equals $50. If the current market price of the stock is less than $50 per share, the formula indicates that the stock price is undervalued. In other words, the intrinsic value of the stock is higher than the stock's current price. Give us a call +9183910944408. Register now www.stockbuysellsignal.com.